Okay, so welcome to part 3 of this financial planning lecture series. Today, we're going to spend a good amount of time talking about taxes and the various tax saving vehicles. As you guys remember from part 1, we talked about risk management and a lot of the insurances. And in part 2, we talked about um, making savings a goal, as well as some debt management and how to tackle, balancing debt management with saving towards your increasing your net worth, as well as towards your financial independence and retirement. Um, and we talked a bunch about budgeting and taxes, right? So if you guys remember the budget that I created, about 40% is going, 30 to 40% is going towards taxes. So taxes are where a majority of your gross income is going, right? So I think it's in your best interest to understand a bit more about taxes and what you can do to mitigate some of the taxes that you pay, all within uh, legal allowed accounts that the IRS gives you. So we'll talk a bit about marginal and effective tax rates. I find that a lot of people, as I've given this lecture over the years, don't know the difference between the marginal tax rate and your effective tax rate. Long and short-term capital gains taxes, which is something that you'll be paying a lot of as you invest your money. The impact of taxes on wealth accumulation. And finally, what are the various types of tax savings vehicles that we have access to as physicians? So I think that, I don't know if you guys know, you guys are familiar with our progressive tax code, right? So this is an example here, right? So uh, using Corey again as our example, uh, mostly because he's on rotation with me, but also because he makes it easy. So
I feel attacked.
I'm giving you very personalized advice, Corey. You should
That is
feel,
true, actually.
yeah. So people charge a lot of money for one-on-one advice. Um, so let's say you make $300,000. You're living in Manhattan, right? And the way that our tax code works is $300,000 means that you would fall into the 35% bracket, right? That's your marginal tax rate. But you don't pay 35% on all of your income, right? I think that's a common um, misunderstanding that a lot of people who don't know about taxes have. So the way that the progressive tax system works is that the first $10,000 you pay 10%. Then you get the idea, right? So each sort of bucket fills up, and you pay that percentage until you hit your marginal tax rate, right? So the highest rate in the Trump tax bill is 37%. So anything above $523,000, you pay 37%. So if you make $300,000 of income, you're going to pay 995 in the first bucket, 3,669, and so on, for a grand total of $75,151. Right. Oh, and by the way, the government gives you a standard tax deduction. So for a single filer, that's $12,550. Um, if you itemize, which means that you list all of your various tax deductions because you have so many, these would be things like, mortgage that you would pay on, charitable contributions, business expenses, etc. So if you can itemize, you can reduce your tax bill even more, right? So if you subtract that $12,550 from 300,000, it ends up being 287,000, right? Is your total taxable amount. And at the end of the day, you end up paying $75,000 in tax. If you divide that by your $300,000 that you pay, your effective tax rate is actually 25%. So, and this is just the federal government, mind you. So you're in the marginal 35% bracket. That's, the highest amount of income that you earn tips you into this particular bracket. And every dollar more that you earn beyond this will start filling up at that 35% rate. But your effective rate is 25%. Does that make sense? Is that clear to everybody? So this is something that confuses a lot of people. So now, remember, I said that's just the federal tax income, right? Federal income tax. So if you're single living in Manhattan, you're making 300K, you pay an effective federal tax rate of 25%. You pay FICA tax, right? So FICA tax is your Social Security and Medicare tax payments that you pay, right? And that's about 2.35%. But because you reduced your federal tax, it actually ends up that as a percentage, you end up paying more of your income in FICA tax. You have New York State tax, 6.1%, and Manhattan City tax, right? Did you know there's a Manhattan City tax, Corey, for the privilege of living in Manhattan?
I did not know.
It's 3.7%, right? So if you live in Long Island or outside of outside of the Manhattan proper, then you don't pay that 3.7%, right? And so if you add all these taxes together, it ends up being $118,000 for an effective tax rate of 40%. See, I wasn't lying about the 40% if you live in Manhattan, right? And this is just your federal, state FICA, and local taxes, city tax, basically, right? Um, there's also, I didn't even put in property tax if you own a property, and I didn't put in things like sales tax that you pay on every purchase. So, you could end up paying about 40 to 50% of your gross income in taxes if you're in a high cost of living area, right? And so this would be your take home pay, even though you're making 300,000, right? So what can we do about this, right? So how can we reduce the amount that we pay towards taxes? Well, just a simple thing we could do is if you put into your 401k, if you put into your HSA, that's $26,000 right there for a single earner, right? And what happens is that $26,000 is deducted from your $300,000. So when you file your taxes, it looks like you only made, 300,000 minus 26,000, and it lowers your effective tax rate. Your take-home pay is still less, but you have all of the savings in addition to that take-home pay. So you've lowered your effective tax rate from 40% to 35% just by using your tax deductible accounts. Okay, so does this make sense? Okay. And so what are the different types of taxes that you can pay, right? So, we talked about income taxes, we talked about FICA taxes, we talked about, property tax, all that kind of tax that you see coming out of your paycheck or when you file a tax return time. There's other taxes that you're going to pay as well, which are taxes on your investments. So that $26,000 that you saved, if it's not in a tax protected account, it would be subject to capital gains taxes. And so what are the different types of capital gains taxes? There's short-term capital gains. So these are any capital asset held less than 365 days, right? Or less than a year. Capital assets are things like stocks in essence, right? And these are taxed at your marginal tax rate. So if you fell into that 35% tax bracket, you're going to be whatever you made, that option that you sold, Corey, that made you $1,000. If you're in the 35% tax bracket, you only made $650 because you got to pay $350 in tax. Okay. If you buy and sell this stuff. So that's short-term capital gains. Anything that you hold for longer than 1 year is subject to long-term capital gains and has a little bit favorable taxation. So, like the day traders, crypto traders, right? They'll pay a lot of short-term capital gains. Long-term capital gains is any capital asset held for more than 1 year. And usually it's capped around, I have to update it to 37%, but usually it's 0, 15, or 20% for long-term capital gains. So for a high income earner, like a physician, an anesthesiologist, instead of paying 35% or 37% in bracket, you might end up paying only 15 or 20% on your investments. So long-term capital gains favors sort of wealthy investors. Other kind of taxes that you could pay, right? So dividend income. So when you invest in a stock, some companies will give out dividends. So dividends are basically a share of the profit that they give to their shareholders. Companies do this to try and have more people invest in their company and buy their stocks. And there's two types of dividends. So there's qualified dividend income. These are taxed at your long-term capital gains rates. And then there's ordinary dividend income, which is taxed at your marginal tax rate. Obviously, qualified dividend income is advantageous to you because you're going to pay a lower tax rate. And finally, interest, right? So if you loan your money, if you buy a bond, for example, the bond is a type of loan. A bond pays interest, and so any interest income is taxed at your marginal tax rate. So it's a lot, right? So bonds, unless you invest in very specific types of tax exempt bonds, generate lots of taxes. Okay, so capital gains, dividends, interest are the three big types of investment returns that are taxed. So, why does this matter? Why do you care if you have some tax on growth? It's you're gaining money, right? So if you give a little bit out. Well, let's use an example here. If you have $1,000 bond with a 4% interest rate, it's in a taxable brokerage account. That first year you earn $40 in interest, right? But it's taxed at your marginal tax rate, that 40% bracket, we'll say, or 37%, right? So that's $16. So in other words, you only made $24 that first year. So your true rate of return after tax is 2.4%. The following year, now instead of having $1,040 compounding, you only have $1,024. And not only that, it's going to grow at 2.4% again instead of that 4%. So you can see where this is going. Taxes also compound. Does this make sense? So just as your investments compound, taxes compound as well. So the more you can minimize taxes during the growth period, if you can get to that 4% without removing taxes from there, then obviously your investment is going to grow more rapidly. Taxes also have an impact in your retirement as well, right? So let's say you have, you're in your retirement, you want to have $120,000 a year in desired annual income. Now, if you only have taxable retirement accounts, like a 401k, a brokerage account, then what happened? Sorry about that, guys. I don't know what just happened right there. Let's try that again. Okay. Well, all right. So if you only have $120,000 in your if all in taxable retirement accounts, like your 401k is taxed when you withdraw money, your brokerage accounts when you withdraw it is taxed, and your effective tax rate is 25%, for example. That means you'll pay $30,000 in federal taxes that year, or federal total taxes, whatever your effective tax rate is. And you'll only have $90,000 left over in income from those accounts, right? Even though you wanted $120,000. Let's say you structured your account such that you had you draw $60,000 from your 401k, which is taxable, and you listened to my lecture way back when, and you actually put money into a Roth account. And so you only took out $60,000 from your 401k, and you took out $60,000 at your Roth. Well, by taking out $60,000, your income is only $60,000, and your effective tax rate is significantly lower at 15%. And the Roth money is totally tax-free, so it doesn't show up as income that's taxable, right? So that means that now you only owe $9,000 in federal tax, as leaving you with $111,000 left over. So by structuring your accounts properly early on, you can see that you can actually reduce the amount of taxes that you pay in retirement as well. So, $21,000 is a pretty significant amount in retirement, right? So that's a couple of nice vacations that you can take just because you structured things appropriately from the beginning, right? So it has proper structuring of your retirement accounts early on has tax implications during growth as well as in retirement. Any questions about any of that? Okay. And so when you invest in something, there's really three kind of phases that there's taxes assessed, right? So there's the contributions. So there's the contribution phase. So this is like if you earned money, pre-tax money, gross income. Then there's you invest in an investment. So during the growth period, there's taxes that are assessed. And then when you take money out of that investment, there's a withdrawal phase, right? So gross income that you earned can be taxed. Investment can be taxed during the growth period, and investments can be taxed during the withdrawal period as well, right? So those are the three phases. And depending on the various rules the IRS has, they can be taxed at different portions of these phases, right? So obviously from this graph, green means that there's no tax due, and red means that it's taxed, right? So what are the different types of vehicles that we can use and how are they taxed? So tax deferred vehicles are vehicles that had no tax on your gross income. So it's taken out of your income the year that you earn it. There's no tax while that investment is growing, but when it's time to withdraw money from those accounts, you are taxed, right? So green, green, red. And the best example of this, the most well known, is a 401k, right? 403b, 457. These are all basically a similar type of account. Traditional IRAs as well act in this manner. If you are a 1099 and you open a solo 401k, right? A self-employed plan, SEP, all of these have this green, green, red. And the idea is that this reduces the amount of tax that you pay on your gross income as you invest. The next category is tax advantage accounts, and these are red, green, green. So this is post-tax money, but during the growth phase, it grows tax-free, and when you take the money out, it's completely tax-free, right? And so the classic example of this is your Roth IRA, your Roth 401k. Backdoor Roth IRA is basically the same thing. It's just how you contribute to a Roth IRA, and we'll talk about that. The 529 plan, which is a college savings plan for or education savings plan for anyone, but predominantly for your kids. If you use it for education funding, then those are tax-free as well. Permanent life insurance or whole life or VULs, all of these things are also tax-free. And so that's one of the selling points that the whole life salesman will try to get you on, is that, hey, you can save taxes when you withdraw, right? And we'll go into that a little bit later. Annuities also as well are tax-free. There's very few accounts. In fact, there's only two that I know of that are completely tax-free. So that means that, there's no tax from your gross income. It's tax-free growth, and then it's tax-free withdrawal as well, and that's your HSA. So, and that's only if you use it for healthcare expenses, right? And then some 529 plans also will give you a state deduction. They'll give you some green space, usually not all of the money, maybe like $2,000 or $4,000 they can deduct from your state taxes. So it's not truly completely tax-free. I think you still have to pay federal tax on those. New Jersey is not a state that allows that. There's a couple of states that do allow you to take a deduction on your 529s. And usually it's if you invest in that state's 529. And finally, where probably a lot of your money will end up being parked is in the all red category, the taxable brokerage account, right? So red, red, red. So this is post-tax money. It comes out of your checking account, goes to your brokerage. Then you invest, that whatever your investment spits out, dividends or capital gains, and then you have to pay tax on that in the growth phase. And then when you sell whatever appreciation you had on that investment, you got to pay tax on that as well, right? So there's a lot of taxes that are assessed, right? After the government has already taken income tax on the money that you decide to invest in, right? And unfortunately, because the government restricts the amount of green space that you have, particularly as a W-2 employee, like a lot of you probably will end up being, we have to park quite a lot of it into these taxable brokerage accounts. Any questions about this? Do you guys understand these vehicles? Okay. So let's talk about the 401k. Oh, I forgot to update this slide. So the 401k is probably the most well-known and probably the one that you all will be contributing to. 403b is basically the same thing as a 401k, except it's just your employer, if they're a nonprofit, they have certain different rules that they file with the IRS and benefits that they get for being a nonprofit. Always get the employer match or vesting, right? That's basically part of your salary. This is money that your employer is giving you, right? The 2021 contribution limit is not drastically different. It's 19,500 if you're less than 50 years old, right? 2021. And if you're older than 50 years old, I believe it's 26. I have to double check that. So it's a little bit more if you're older than it is. They call it the catch-up contribution. And things you should know about your 401k, any withdrawals that you make from this account before the age of 59 and a half is taxed at your marginal tax rate. So if you're still earning a lot of money, it's going to be a significant amount of tax plus a 10% penalty. Certain exceptions apply, things like hardship withdrawals, loss of your job, disability, and actually with the CARES Act last year, because of COVID, they allowed you to withdraw $100,000 of your 401k money at your marginal tax rate with no 10% penalty. And withdrawals are taxed. Yeah, withdrawals are taxed at your marginal tax rate. So that's 401k.
Question. So say you like hypothetically retire at 50 years old and you don't have a job, then that means you pay 0% tax and then just a penalty of 10%. Like if you don't have a job,
And so they actually, I guess they realize that there are people who like to retire early. So there are certain exceptions. There's you can do something called Roth conversions. And what you do is that you roll it over to a Roth IRA. And when you do that conversion, you don't end up paying the penalty, but you just pay the marginal tax. And then later on, you can withdraw from that Roth account the principal that you put in penalty free. So there's ways that early retirees can get access to this fund with sort of minimal taxation. Does that make sense?
Yeah.
Yeah, and IRS is also clarifying some of the early retiree kind of goals as well. So, but really, it's designed for late retirement account, later stage retirement. Now, so Corey asked the question of, what if I want to take the money out early? Is there a way I can get around that? And there are certain ways to get around that. If you show that you don't have income and that you are an early retiree, they'll let you take a certain percentage out. But if you are someone who's planning on saving a lot of money, then you might actually have the opposite problem where you end up having too much money and you're like, oh, you know what? I don't really need to touch my 401k because I have income from other sources, like my taxable accounts or something like that. And I just want to let it sit there and keep growing. Well, the government says, no, we want to get tax on that money somehow. And they have something called RMDs, or required minimum distributions, right? So this is something that a lot of retirees face. And the government basically says at these particular ages, you need to take out a certain percentage of your 401k, right? So do you guys remember from, I think it was the second lecture, the safe withdrawal rate, right? So you should withdraw about 3 to 4% of your portfolio per year to make sure that you don't run out of money, right? Well, as you can see, you exceed that 4% at the age of 73, just when RMDs start. And at age 80, they expect you to withdraw 5%. At age 90, 9%, right? So at age 100, like 15%. So they expect you to just take that money out and pay your taxes on that money. So that's another thing to think about. Another reason why you might potentially want to start converting some of that 401k money into Roth money early on in your retirement. Any questions about RMDs? And this is if you are a super saver, you could run into this problem. You might end up having too much money, actually, and then you end up paying massive amounts of tax on money that you don't need to take out of your account. So you don't need that money. So you have to kind of, again, structure your accounts in a way to minimize that amount of tax and not be stuck with paying giant tax bills for nothing. Another type of taxable account is the traditional IRA. So IRA, of course, stands for Individual Retirement Account. And so the 2021 limit, I believe, is the same. I apologize for not updating these slides. 2021 income limit, I believe, is still 6,000 for someone who's less than 50, and for someone who's greater than 50 years old, it's 7,000. And the traditional IRA was designed for those who are perhaps are W-2 employees, but their employer chooses not to offer a 401k for their employees. And so you can contribute to a traditional IRA in that situation. But there's a pretty quick phase out. If you make more than 70,000, it starts to phase out. You can't take a tax deduction. If you make more than 118,000 married, filing jointly, you can't take a tax deduction. So the key thing is that so this traditional IRA will become important later on when we talk about backdoor Roth IRAs. And the reason is that even if you exceed these income limits, you can still make contributions to a traditional IRA, but you have to specify that it's a non-deductible contribution, that I'm putting money into this account, but I'm not going to take a tax deduction on this account. Does that make sense? You guys pretty much shouldn't really be using a traditional IRA at any point until you're ready to start contributing to a backdoor Roth IRA. Now, where people will sometimes have massive amount of money in a traditional IRA, and a mistake that you should avoid, well, it's not necessarily a mistake, but I recommend against, is that when you leave jobs, for example, you have money sitting in a 401k account or a 403b account from a previous job, and you want to bring that money somewhere else. Sometimes people will roll that money over into a traditional IRA fund, right? So old 401k, and they roll it over to that traditional IRA. And the idea is that they have, more control over their money, because the traditional IRA, you can open with any brokerage account, you can invest it however the heck you want, right? The problem is that when you do that, then that money kind of gets stuck in the traditional IRA. I think you could potentially roll it over to a new 401k account, but I'm not 100% sure about that. But the money gets kind of stuck in that traditional IRA. And so you're better off leaving the old 401k money where it is. So that's the traditional IRA. The Roth IRA, right? So you'll hear me talking a lot about Roth IRAs. I already said you guys should be contributing to a Roth IRA already if you can, if you haven't been. And so the income limits are to contribute to a Roth IRA are the same. So the 71,000 single or 118,000 married filing jointly, and there's a phase out. And you can contribute $6,000 per person, less than age 50, and $7,000 per person if you're greater than age 50. And I believe it's the same for 2021. And so the benefit of the Roth IRA, as we discussed in the previous slide, right, it's red, green, green. So the idea is that it's post-tax money, but you're in a lower tax bracket right now, so that's fine. You're not paying a whole lot of tax on your gross income, but any growth and appreciation that you have on your investment during this time will be completely tax-free. So if it grows to, $2 million or $3 million, you can take all that money out completely tax-free, with the same retirement account rules, which is 59 and a half at age 59 and a half. Now, Roth IRAs does have the exception, unlike a 401k or traditional IRA, in that any principal amount of money that you put in, like this $6,000, you could take out, and because it's post-tax money, you could take out and spend it however you want without paying any tax. The part that benefits you is that if that 6,000 grows to, let's say, $18,000 after a couple of years, you would owe tax, because it's in a Roth, it's completely tax-free, but you can't take out the other 12,000 until you cross that 59 and a half year threshold. Does that make sense? So Roth IRAs are pretty powerful, especially for people who save a lot of money or who are in a high tax bracket, and who will be in a high tax bracket in retirement, or people who generate a huge estate. The other benefit is that Roth IRAs, when they're passed on to your heirs, your kids or whoever, then that money is tax-free for them as well. So that's a big deal. Any questions about Roth IRAs, traditional IRAs?
I still don't fully understand the benefit of a traditional IRA then.
Yeah, so traditional IRA, the benefit is that if you are a low income earner,
I see.
then that's where it helps you, right? So if you're making, $40,000 to $50,000 a year, and that's your whole career, you're making $40,000 to $50,000 a year. It's a means of saving and getting a little bit back, right? So when you put that $6,000 in, you might get, 20% back, right? So that's $1,200 that you could use for something else, right? So you're saving and you have a little bit more extra cash to spend on something else or invest in something else. So traditional, that's why I said for you guys shouldn't really be messing with traditional IRAs, because you are in a low income bracket and you can contribute to a Roth IRA. Oh, by the way, I forgot to mention, you can't contribute to both traditional IRA and Roth IRA. The total contribution to both accounts is $6,000. Okay, so that means that you can put all 6,000 into a Roth, all 6,000 traditional IRA, 3 and 3. You get the idea. Same thing with your 401k, by the way. So a lot of company 401ks now will let you take a tax deduction, or they will let you put into what we call a Roth 401k, and the total limit is 19,500. Does that make sense? Okay.
Yeah.
So now I contribute to a Roth IRA, even though I'm well above the contribution limits. And how am I able to get away with this? Well, there's something called a backdoor Roth IRA, which you may have heard of. And so, how did this come about? Previously, there was a law that said if you make more than a certain amount of money, 118 grand, married filing jointly, then you can't contribute to a Roth IRA. But not only can you not contribute, you can't roll over or convert 401k money or traditional IRA money to a Roth IRA. And the part of the law that said you can't convert expired in 2010. They kept the part that said you can't make contributions, but the conversions, they decided not to renew. And so how does this benefit us? Well, what you can do is you can convert to, so this year, what will I do? I'll put $6,000 into a non-deductible traditional IRA. I'll just call it TIRA. Okay, into a non-deductible TIRA, because I can't get a tax deduction on it because I make too much money, right? But I can put into a non-deductible traditional IRA. So if I do this just to test your understanding, the three phases, which parts will be red and which parts will be green? Any takers? Right. So the
you pay tax up front.
Yep, that's red, right?
And then you don't pay tax later for the next two.
Well, the growth phase is tax-free, but when you withdraw money, this is going to be red again. Does that make sense? So if you put into a traditional IRA, it would be green, green, red. Let me go back, right? If you put into a traditional IRA, right, it'd be green, green, red. But if I don't take a deduction because I make too much money, I can't take this tax deduction here. So it becomes red, green, red. Does that make sense? Now, so you could do that. You could, it's not a huge benefit, but it's a little bit of a benefit. It's better than red, 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 right? In your taxable brokerage account, right? So now why would you bother with all this? Because what you can do is after you put into a traditional IRA, because the conversion part expired, you can then roll it over to a Roth IRA or do a conversion to a Roth IRA. And the idea is, well, it's post-tax money that I put into this traditional IRA, which is basically the same thing that I would do in a Roth IRA. So I'm rolling this over into the Roth IRA. So now I went from red, green, red to red, green, green. Does that make sense? And so, why would you do that? Well, it's 6,000 per person, right? So I do this, my wife does it, so it's $12,000. For the past 10 years, just from principal alone, we put in $120,000 into the Roth, and of course, the money's going to double every couple of years depending on your returns. So, that's already like $250,000 in 10 years of completely tax-free money that I can use however I want, or I can pass on to my heirs completely tax-free if I want to, and it will keep growing, of course, over the next, the course of my whole life. So it can end up becoming a substantial bucket of money, and so that's why you should try to put as much funds into your Roth as you can stomach in terms of your living expenses and whatnot, as we talked about in the budgeting section. And then after your first year as an attending, you should start considering doing backdoor Roth IRA contributions as well. This is a little bit, it's only been out since 2010, right? So it's a little bit of a confusing subject for a lot of investors. And actually, even I found CPAs as well who are not familiar with this strategy. I've had to educate a couple of CPAs on how this strategy works, but it's pretty well documented all over the internet. If you go to any of the finance bloggers, they'll write about, even some will have literally step-by-step instructions of what to do. So any questions about backdoor Roth? Okay. And so one of the reasons why I say don't put into a traditional IRA, there's something called a ProRouter Rule. And I think I mentioned in a previous talk, I had an attending come up to me and said, oh, you talk about this backdoor Roth. Can I do this? Can I do this as well? The problem was that they had a lot of money in a traditional IRA because they rolled over a whole bunch of 401k money. And the way this works is that, the way that I do this every year is the start of the year, I have a traditional TIRA account. I have a Roth account. The start of the year, my traditional IRA account has a balance of $0, and my Roth, let's just say, I did it once last year, has $6,000. So I'll put in $6,000 into the traditional IRA this year, okay, and I'll convert that to Roth. So now my Roth account has $12,000. Okay. At the end of the year, my traditional IRA has a zero balance, right? It's important to have that zero balance because in order to do the conversion, the IRS doesn't allow you to just convert $6,000. They say whatever traditional IRA money you have to convert all of it. So if you rolled in money from your 401k or 403b, all this stuff into the traditional IRA, you got to convert all of that money and you got to pay tax on all of that money. Now this $6,000, you don't have to pay any tax because it's already post-tax money, right? But if you rolled in 401k money that was never taxed because it's pre-tax, right? Then you're going to have to pay tax on that entire conversion. And it can be very expensive because you are in a high marginal tax bracket. Does that make sense? Did I lose anybody? So that's the process of doing a backdoor Roth, right? And the idea, once again, is these are different vehicles that'll decrease your the amount of tax that you pay and maximize the amount of green space that you have, which is not a lot, right? As a high income earner and as a super saver. So the backdoor Roth might disappear in the future. And it's not, the end, it's not going to probably, if you don't do the backdoor Roth, it's not that it's, you can't achieve financial independence and you're doomed, but it's a nice little bonus to have if you are somebody who's diligent about saving and getting that extra little nuanced amount towards your financial independence. The government's pretty much made it clear that they're not going to get rid of this conversion because they've had opportunities to get rid of it already with new legislation and they chose not to. I think primarily because they just want to get their tax money now, right? Okay, whole life insurance. So in the previous talk, I talked about whole life insurance, and I talked about how it's not a good investment for the vast majority of people. And I think it's talk one that I talked about whole life and the opportunity cost of just getting term life and investing the difference. Now, why would whole life be considered a tax advantage accounts, right? So there is a small, tiny percentage of people where this would help, right? So this is people who are very diligent about saving, super savers, who don't have much access to the green space. And the idea is that, your whole life, you accumulate a cash value. And then after you accumulate the cash value in retirement, you can take a loan against your cash value. If you have let's say $1 million policy and you put in $250,000 into that policy, now that policy is worth 1.25 million, right? But the cash value is $250,000. So in retirement, you can now take that 250,000 or parts of it out without paying tax because it's not income. You're just taking a loan against your life insurance premium, right? And so that's the idea of why they sell whole life as a potential tax savings vehicle. Now, if you remember from my first talk, the problem is that there's a lot of commissions and fees that are involved, right? And so you have to kind of do the math, right? So which is worse, paying tax in your taxable brokerage account or paying all these fees and commissions, right? And if you do the math and you look at your particular situation, sometimes it actually might be better. The fees and commissions might actually end up be paid less than the total amount of tax that you might owe over the lifetime of this investment and withdrawal. But a lot of times the tax side will actually come out ahead. So for this reason, I don't really recommend whole life. And again, you should only really be having this problem if you're already saving lots and lots of money. So, I get very angry when people sell whole life to particularly like residents or even medical students, right? So I had a medical student who was sold whole life insurance because it serves no purpose in that setting, right? It's only if you are a very diligent saver. Does this make sense? Okay. VUL is basically a type of whole life, right? So there's different types: IUL, VUL, variable universal life, and so this is it's kind of like a taxable brokerage account within the whole life policy, within the life insurance policy, where you can pick and choose what investments you want to invest in. Whole life, traditionally, typically, they just give you a dividend, right? So they'll say we'll pay you 6% or whatever, and you don't have to worry about how we invested and all that. VUL, you can actually have control. You can invest in however way you want. So you could potentially have it so that if you could potentially lose money in a VUL if you have a down market, right? So if you structure VUL appropriately, it can act almost like a Roth IRA in some settings. But again, you have to do the math of, what's going to be better if I just invest in a taxable brokerage account, the red account, or do I pay all the fees and commissions in the VUL and invest it in like an aggressive growth stock options? And will I come out ahead in that way, right? And for the most part, I don't really recommend, any permanent life insurance to be used in toward building wealth. Building wealth. Any questions about life insurance, VUL?
So what do you do with that loan that you can withdraw tax-free? Like, can you reinvest it?
Well, you could spend it.
Do whatever you want. No.
Right?
Okay.
Because it's already invested. So like in a VUL, for example, it's invested in whatever, in funds or stocks or even, commodities, anything. And so when it comes time, it's still growing and accumulating just like, your 401k or taxable brokerage account. So when it comes time to withdraw the money, instead of withdrawing money from a taxable brokerage account, which will generate a lot more tax, you potentially will withdraw from the VUL and spend that money tax-free.
I see.
Right. So if you remember the slide about taxes in retirement, If you have only all taxable accounts and you're somebody who wants to have a pretty decent retirement, $120,000, $150,000, some of you tell me $200,000, all of these things they'll generate quite a lot of tax, right? $200,000 is a pretty high tax bracket. So if you say have your VUL and you withdraw $100,000 from your VUL or your Roth IRA, and you have 100,000 from a 401k, then potentially you're going to pay much less taxes in retirement. And so the next account is the HSA. So the HSA is a great account because it's completely tax-free, right? Green, green, green. And so for 2021, it's the same, $3,500 for a single earner, single filer, $7,000 for a family. So there's no tax on that $7,000. There's no tax during the growth phase. And when you withdraw that money and spend it on healthcare related expenses, there's no tax at all, right? So this is one of the only accounts where the government says we're not going to take any tax from you at all. And this can, add up to quite a lot, right? So, $7,000 over 20 years, $140,000. If it doubles a couple times, you're talking about, it could be like $500,000, right? And that's a pretty significant amount of money. Now I know Corey's going to ask me, he's like, I'm such a fitness buff and, everyone in my family lives to be 120 years old. What if I have too much money in that account, right? Oh, and so if you ever withdraw money from this account for non-healthcare related expenses, then you have to pay your marginal tax rate plus a 20% penalty, right? So if you put in HSA and then you're like, I want to use this to buy a new car, then it's more than 50% of your HSA money will be lost in taxes, right? However, in Corey's situation, there is a special opt-out. And what the government says is that after age 65, you can use the HSA funds for non-healthcare related expenses without a penalty. You just pay your marginal tax rate at that time. So at worst, the HSA is like a 401k, right? It's just even more money that you could put towards a 401k. But at some point in your life, you're going to have healthcare related expenses, right? So even things like Medicare premiums, I believe, can be paid for with your HSA. So does that make sense? So Corey, despite your longevity, you still need to invest in HSA.
And you can invest the money you put in your HSA account like a normal like IRA or 401k. Like it's not just $7,000 flat. Like it can grow.
Correct. Yeah. So it depends on the plan administrator. So it depends on, each employer will have their own HSA administrator. But, for my HSA, I have it invested in an index fund, in a stock market index fund. And it grows. Yeah. Now, you only get access to an HSA if you have a high deductible healthcare plan. So, my advice generally is it's a nice bonus, but don't pick your healthcare plan based on whether or not you have an HSA. Pick your health plan based on what you think is going to be required for your healthcare needs. Now, if most of you are young and healthy and don't have any real healthcare needs, so you're not going to really be meeting deductibles. So when you're young and healthy, that's the perfect time to have a high deductible healthcare plan with an HSA and contribute shovel money towards that HSA. Does that make sense? Okay. And I think the last thing, we're zooming through the lecture. The last thing is college 529, or I shouldn't call it college plans anymore because with the Trump administration, they basically said you can use 529 plans for almost any education expenses, right? So private school education from kindergarten to high school as well. And so these are generally post-tax dollars, although there are some states that will allow you to take a small tax deduction, a couple $1,000s, which grow tax-free and can be withdrawn tax-free for qualified higher education expenses. Multiple states, and you don't have to open a 529 in the state you live in or the state you want to end up in. Like my kids have a 529 in Utah. And so the Utah's 529 plan is very well liked because they have low fees and they have lots of investment options. So it's very customizable, for example. So if you withdraw that, so this is red, green, green. If you take that money out and use it to spend on these education expenses, there's no tax on any of the appreciation. If you decide to use it to buy a car, then you have to pay your marginal tax rate and as well as a 10% penalty. Now, what if you say, well, what if your kids never go to higher education, right? Then you can rename the 529 plan to someone else, to your grandkids, to your nephews, to yourself, if you decide to go back to school, go back to college for something, right? Or the other possibility, what if your kids end up getting a full scholarship? Now you oversaved in this 529 plan. Well, they let you, if you show that your child received a scholarship, you can draw money 1-to-1 for the amount of scholarship dollars without a penalty and just pay your marginal tax rate on that appreciation. So that's 529. Any questions about that? By the way, you can even open a 529 even before you have kids. So, Corey, after you contribute to your Roth IRA, you can then open a 529 under your name, and then once your child is born, you can rename the 529 in their name. So you can even get a jump start on this.
My kids are probably not smart enough to go to college.
Save it for your grandkids then. You could give it to charity. So there you go. So part 3, actionable items, right? So identify the type of tax savings accounts you have access to and maximize your green tax-free spaces. Structure your accounts in a way to minimize taxes during those 3 phases, right? So during the contribution phase, during the growth phase, and during the withdrawal phase. And it's not like if you mess up, that's it. It's over. It's just that if you learn how to do it properly from the beginning, and you can make mistakes along the way, right? So I bought whole life when I was a resident because I didn't know any better, and I ended up selling the policy. It took a little bit of a loss on that money, but it was fine. I redirected the money in the proper way. So you can still kind of learn along the way. I'm sure there's stuff that I don't know about still that I have to learn along the way. So, but the more you educate yourself about these things and the more you can kind of maximize your green space, the faster you'll get towards that wealth and financial independence goal that you have. Any questions about any of this stuff? Is that pretty clear?
So after you maximize all these accounts, is there anything else you can do? Like say you're a super saver and you have all this extra money. Is there anything else you should do with or put your money somewhere?
Yeah. So as a W-2 employee, you're kind of restricted, right? So as a W-2 employee, really it's so we talked a little bit about 401ks actually allow up to $57,000. But you are limited to $19,500 as the employee, but the employer could fill in the rest, right? So that's where the match comes in. You can negotiate with your employer, right? So one of the things that we did was, as a group, we said, you're putting in like $20,000. We're putting in $20,000. It's $40,000. It still leaves $17,000 of space that the IRS allows. What can't you let us put in a little bit more of tax? It's kind of like a backdoor Roth almost, actually, is what I do. And that's something I spoke with, a big corporation, Napa, right? And it was able to get them to restructure that with their retirement account administrator. So there's some of that. If you are going to end up having, if you are planning on a huge nest egg and you're planning on, lots of money in retirement, then you start looking at some of the more fancy things like VOLs that I mentioned. There's something called defined cash benefit plans, which I won't go into. So there are some other vehicles that you can use, but they end up becoming a little bit almost, too complex, and things can kind of go wrong where you're better off just putting into a taxable brokerage account, honestly, at that point, unless are committed to doing that for a long time. So, but it's not, it's not an insignificant amount, right? So, for example, my wife has, gets her 401k 20,000. I get 20,000. We have HSA 7,000. We both do backdoor Roths, right? So that's another 12,000. So that's what is that, like $60,000 right there? That has a good amount of green space, right? And then the rest you can put into other vehicles, or just put it all into a taxable brokerage account. That's fine too. Taxable brokerage account isn't necessarily the worst account in the world, because it does give you flexibility. If your life situation changes, you need to take money out, you just pay a little bit of tax on that money when you sell. Whereas like in a 401k or a Roth IRA, your money's stuck. You can't really get it out easily. So does that make sense?
Yep.
All right. So I went through this a little bit fast. Usually, when we're live and interactive, there's a lot more questions. So I hope I didn't gloss over too much of the detail. But the next session is actually going to be even shorter than this. So it's kind of be talking about how to construct an investment portfolio and the considerations of constructing a portfolio, and then kind of a recap of everything, and a more sort of Q&A time. So if you guys have questions next time, get them ready. All right. Thank you for joining.
Thank you.
I'll see you next time.
Thank you.
Mm-hmm.